Okay, so why don't we start? Tom, why don't you introduce yourself?
Sure, I've got a company called Handy Ramp or Handy Products. We make ramps for people with disabilities. We're primarily a metal fabricator. In addition to that, we have a product line that deals with moving material handling ramps, and we have a whole slip and fall prevention product line. Been doing this now 25 years, and you know, these are, as everybody says, these are challenging times.
Okay. Ray?
I'm Ray Markman. I founded a company called Global Capital Advisors. We raise money for companies. I've been a serial entrepreneur since I was 22 years old, which is a couple of years ago. And I founded 9 companies, took 4 public and sold the other 5. And what we do now is raise money. We have a lot of people who follow us and give us money to invest for them. And so we invest in every kind of company. And we're very interested now. We're focusing on real estate, which is through Bill, we're hoping to get the right kind of deals.
Naomi?
Yeah, thank you, Naomi Kent. So I run the North American operations for a company called In Touch Networks. We're a network of senior professionals who are going through career transition. So we offer coaching, resume writing, and a host of other services. We actually do a lot of placement on boards. So Ray, you and I should chat. And I currently sit on an advisory board for an iced tea company. And I just joined the board of the BABC, which is the British American Business Council in Chicago. Passionate about real estate. I don't own any commercial real estate, but I do own residential real estate and rent a bunch of those out. So I'm very passionate about that area.
Okay, and Jerry?
Jerry Haliski. I'm one of the 2 managing partners of a 50 lawyer law firm, Ehrenberg Goldgen, in the old IBM building. I guess it's the AMA Plaza currently. Have the 17th floor there, about 30,000 square feet. I'm always interested in what's happening in real estate, since we have a lease coming up in 2 years and 4 months. and our firm is a full service law firm. My particular area is in business transactions, M&A, specialty in business divorce, split ups, squeeze outs, freeze outs. And like you, Ray, I also work with a lot of advisory boards. I've actually used that as my entree into some of my biggest clients, has been setting up an advisory board for them and serving on it.
Okay, and Mike?
Yeah, Mike Parrish. I'm soon to be a CEO Emeritus of a division of Bernina International. I sell through 20 different countries around the world, obviously, primarily Europe, US, Canada, Australia, and a little bit to South Africa. We run 4 divisions within our group, and our divisions primarily focus on consumer products, selling B2B, B2C, and anyone who's got a check, we will sell to.
Oh, so you're very selective.
If your money check won't bounce, that's the only criteria I have.
Okay. So that means that you won't sell to the NBA because they bounce.
That's right. Their ratings are too low. And I'm here to listen to Bill, because every time I listen to Bill, I learn from Bill.
Thanks, Mike.
Okay, Jim White?
Yes, hi, and I apologize that you can't see me. I'm unintentional incognito here. I am the CFO and co-owner of Burton Medical. We're a medical products or a medical lighting company in Addison. We got a 30,000 square foot facility. We're a manufacturer and distributor all over the world, really. It's a 92-year-old company, so a very old company with a great brand name. So our timing of renewing our lease was probably very poor, because we did it right at the beginning of the year. And anyway, we haven't really, well, we've worked with Bill. I was referred by a former colleague of ours, and Bill has been very helpful, but hasn't got any revenue from us yet, so I'm hoping to change that.
Me too.
Yeah.
No, thanks for joining, Jim. I appreciate it.
And Barrett?
Yep, I run an outsourced CFO firm. I have a couple of clients. Historically, I've been an investment banker, private equity investor, and then ran a business for a little bit, and then pivoted to this. I'm not a real estate guy by trade, but have somehow found myself in it. I've got one business that, because of COVID, has doubled, and we're looking for a 30,000 square foot building to lease. I've got another client that has a vacant building, looking to dispose of that as a result of COVID and losing out on their tenants. So getting a little bit more involved in real estate, and thought this would be really helpful to learn more.
Okay, and we're all lucky because we have Bill Himmlestein as our resource today. I'm going to turn the hosting over to Bill so that he can use his PowerPoints and all that. So, Bill, you are now the host.
Right? All right. Let's see if I can do a little screen sharing here. Let's see. Is everybody able to see what's on my screen?
No,
Just your face.
Did you
My
go?
face. No one wants to see that.
Did you go down to the bottom where it says screen share? And
Yeah.
click on that?
Then you've got to double click on it and click share, I think.
Okay. There we go.
Yeah, that's
How's
it.
that?
Yep, we got it.
There we
All
go.
right. That's the wrong presentation. We're going to this presentation. Can you all see commercial real estate in the COVID era?
Nope.
No,
No.
sustainability.
We've seen sustainability and climate change. Maybe that's a better topic. Okay, now we see it.
Now we got it.
Commercial real estate.
Yep.
Good. All right, wonderful. Well, Ray, thanks for organizing this. I appreciate the opportunity. A little bit of background about myself. I've been a commercial real estate broker for a little over 20 years. I started my own business about 12 and a half years ago, specifically to represent the best interests of tenants, buyers, and sellers of commercial real estate. That's really, I think, all that really needs to be said. What I want to do today, the goal is to go through a little bit about what's happening in the market. This is predominantly going to be Chicagoland facts and figures. But what Chicagoland is experiencing is fairly similar to elsewhere around the country. So, there's a couple of sections I'm probably going to skip through here. And then this presentation will be sent out to, everyone who participated today. So you don't need to take notes. But if you have any questions at all at any time, it can be about anything. If I know the answer, I'll share it. If I don't, I'll tell you. This is hopefully meant to be a little bit more interactive than me just spewing facts and figures at everybody. So let's dive in. The main points that I want to cover today are going to be the state of the current market, some stats and figures about vacancy rates, sublease availability, and rental rates. And then I want to take those numbers and actually put them into some context, how they stack up historically, because I think that's pretty important to understand. We can look at numbers all day long, but until we have some context around those numbers, they don't take on a ton of meaning. Those first two sections are going to be predominantly about office space, and we're going to touch a little bit about what the other two main sectors in commercial real estate are doing, and that would be retail and industrial. We can touch a little bit on buying versus selling, or buying versus leasing, and what factors contribute to whether it's a good time or not to be a buyer, seller, or renter. Then a big key here, since the beginning of the pandemic, I've spoken to approximately 250 business owners. And I just kind of want to share what those business owners are thinking, what they're saying, and what they're doing. We're reading a lot. The media needs to sell newspapers. They need to sell their content. And so they might throw something out there, and very little of what I've read through the traditional media publications hasn't really stacked up to what I've heard or seen in the market. So I want to put some clarity around that. One aspect that I've usually kind of skipped over, and I can send out further information, is about how to come back to the workplace safety. I'm happy to touch on that if people are interested, or I'm happy to skip over it if there isn't as much interest. And then lastly, this is kind of the meat and potatoes of this presentation, is the ways that you as business owners or investors can take advantage of the current market conditions. So these statistics that I'm going to share were based upon the end of the third quarter. And I can give a little bit of additional color around what has happened since then, in the few months since the end of the third quarter. There has been, so far in the third quarter, we added 3 million square feet of sublease space in the Chicago market, bringing our total to over 9 million square feet of sublease space, which is the largest amount in the history of Chicago that we've ever had on the sublease market. There was 6 million square feet of new development has broken ground, of which 3.8 million of that is still available. So once those hit the market, presumably we'll have close to 4 million additional square feet of space hitting the market. At the end of the third quarter, the vacancy rate was up to 12.9%, which would be its highest rate since 2014. That has since climbed to about 13.5% vacancy rate. This is for downtown office space. Now, here's an interesting statistic. Rental rate growth has dropped to 0.5% year over year. Now, that's the growth in the rental rate between the end of the third quarter and last year has slowed to growing to 0.5%. We do believe that we will see negative rent growth in the first and second quarters of next year, potentially the third quarter, although that's kind of where I anticipate a flood of activity coming back to the market. And we'll touch on that more later. But, a lot of people think that, the rental rates have been in office space have been taking a nosedive, and they haven't. There's some information about what the average rental rates are in the marketplace. Now,
I mean, the average charge, the rental rate, the cost per square foot if you're going to rent something, is that what that refers to?
That's exactly right, Tom.
Okay.
Yeah. So now it's important to take those numbers that we just went through, which, that's what the media might put out. Holy cow, there's 9 million square feet of sublease space on the market, and that's the most we've ever had. Well, that signals panic, right? That signals to tenants you can get an amazing deal. However, when you put that into the perspective of there's over 500 million square feet of space and over 210 million square feet of space in the downtown market, that really only represents about 1% of vacancy being added to the market. So it doesn't really move the needle that much. So that's what I found interesting is I'll have clients call me and say, Bill, there's 9 million square feet of sublease space. Rates have got to be plummeting, right? And I say, well, that 9 million square feet represents about 1% of the total market. Same thing with that, the new development, the 6 million square feet represents less than 1% of total inventory. So the market is not hemorrhaging. The market is not in distress right now. And that's the office market.
I have a question.
Please.
Is there any data as to the delinquency rates comparative aspect?
Yeah. The landlords are collecting 94% of what they were collecting pre-COVID. So it's another important, that's a great question, because it's important to understand that just because there's 9 million square feet of sublease space doesn't mean that those landlords aren't still collecting those rents. There are some tenants that have gone out of business. There's some tenants that have defaulted on their leases, but collections are 94% of what they were pre-COVID. So I think that's a pretty, and you know, a lot of people think, well, there's no one going downtown. Right now, these buildings are seeing approximately 20% of the amount of people coming into their office as they were pre-pandemic. But those companies are still paying rent. That's the thing. This doesn't mean that that space is vacant. It just means that people aren't going there. So there's the big discrepancy that needs to be understood.
Well, there's a strategic implication in that though, and I think that is, if I were a office space owner in the city of Chicago, I would be very, very concerned about how many people would continue to need to rent 80% vacant space versus can I now change my model so that more people are operating from home? My wife works for a large bank, and right now they're like, you know what? We have all this office space we've been using, and I don't see us needing it. We're not going to change the way we're doing business now, even when COVID is gone. People are, and they're saying people are just as productive from home. I'm not sure I buy that, but that's what they're saying. And as a result, they're not going to need as much office space because people are going to office from home. It's a strategic question.
Yeah, no, you raised some great points, and we're going to get into that. I've got some statistics about that. I think the biggest key is that, you know, you talked about the people are just as productive. However, if you ask most business leaders, productivity is not the single most important measure of the success of your business. And a lot of success for a business, and this is with decades of research, is about culture, building a top culture that supports the attraction and retention of top talent. And there's a tremendous amount of research that will show it's extremely difficult to build an award-winning culture with a remote workforce. Now, to your point, Tom, and we're going to get into this later, there will be a more flexible work from home policy as a result of this. And that might produce a reduction of need for space of, let's just say 20%. Let's say you allow people to work from home at least one day a week, and you've decided you need 20% less space. However, there are other reasons of why we think companies are going to continue to grow. They're going to redesign what their space layout looks like, which will require them to need more square feet per person. I'll get into that later. So these numbers that we were talking about, we want to look at how they compare historically. We talked about how at the end of the third quarter, vacancy rate was just shy of 13%, and most recent figures will show us at about 13.5% vacancy rates. Historically, for the last two economic expansions, vacancy rate got to as low as between 7 and 8% for downtown office space in Chicago. In the last two recessions, the dot-com bubble bursting and the financial crisis of 2008, vacancy rates climbed to as high as 17 or 18%. So what real estate professionals typically talk about equilibrium, meaning the landlord nor the tenant has a clear advantage, is about 12.5%. So we're really not that far, being at 13.5%. Landlords, you know, if you're looking at it today through that lens of the current outlook, they're not in a dire situation. They're not dropping their rates too much. That's what we see in the next slide, how we mentioned that rental rate growth has slowed, and we do predict there'll be negative rental rate growth in early 2021. What we're seeing from landlords right now, direct landlords, is not necessarily a big drop in rental rates, but we are seeing greater concessions offered, like more free rent, more tenant improvement allowance, a little bit more flexibility through rights to expand, contract, or terminate leases. But landlords so far, they're not dropping rates significantly.
Well,
We do see that coming somewhat in the first and second quarter. But it's, people who are expecting 30, 40, 50% discounts to rates, you're only going to see that potentially on the sublease market, which leads me to the next slide. On the sublease market, there's an important thing to understand. With that 9 million square feet of sublease space on the market, let's say you're a tenant in the market and you're a law firm that needs 5,000 square feet in the central loop, and you'd like to have 3 to 5 years left of term on that sublease. Well, that means you need to find a space that's built out for a law firm, that's in the central loop, and that has the amount of term left that you want on it. Of that 9 million square feet of space, there might be 2 to 3 options that are going to make sense for you, maybe less. And so just because there's 9 million square feet of space, like for example, Groupon, who subleased 150,000 square feet at 600 West Chicago, they're not going to sublease any of their space unless you probably want at least 75,000 feet, and you're okay being at 600 West Chicago, and you don't mind the layout. So it's got to be a perfect fit. And a lot of times these, of a lot of the sub landlords that we're representing, they're not dropping their rates dramatically, especially if you've got a lot of term left. If you've got 3 years or more left, you're not dropping your rates 30 or 40%. You might drop them 20% relative to what the direct building is offering. But there just hasn't been that. The times when you see a 50% reduction on rates in a sublease is when there's only a year of term left. So that means you're going to move your business into that space. You're going to enjoy a 50% discount for 1 year, and then you're going to be back to direct rates, or you're going to be moving again. So it's something important to consider. Just because there's 9 million square feet of sublease space, every single one is laid out differently. Sub landlords don't reconfigure their space. You take the space as is. And so it really hasn't created a tremendous amount of opportunity for any given tenant. There might be a couple that fit your needs. And even then, you're probably not going to be seeing tremendous discounts. So Tom, here's this study that Jones Lang LaSalle did that kind of addresses your point. They are forecasting over the next 2 years that the vacancy rate will increase by 10% due to businesses going under, due to a more flexible work from home strategy, and due to companies reducing their headcount and the amount of people they want to see coming into the office. On the flip side of that, Tom, this is the part that a lot of people don't think about, they don't realize, is that they're also forecasting a 10% increase in demand due to change in the office density and economic growth. So let's address both of those points. Right now, the last 9 months since the pandemic started, there's been a tremendous amount of investment capital sitting on the sidelines. I'm sure guys like Ray Markman have seen that, and probably Barrett Willich. There's been a lot of investors that have just kind of been holding off, waiting for things to become more clear. And we got through the election, and at least we have some clarity now on who's going to be in office, presumably for the next 4 years. But there's going to be a lot once we have a clear path to vaccination, and that starts to happen. Most economists and lots of the people in the real estate industry are predicting that demand, companies are going to start growing again. They're going to start getting that investment. They're going to start planning for the long term and looking to the future. Most people don't look to the future and say, we're going to downsize and we're going to decrease our operations. They're trying to grow. That's what businesses do. And we believe that's going to continue, as well as the change in office density. Now, here's a statistic I want to throw out at you. When I started in commercial real estate 20 years ago, the average square feet per employee across all industries in downtown Chicago was 470 square feet per employee. Fast forward to pre-pandemic, and the average square feet per employee was down to 190 square feet. That's practically shoulder to shoulder, right? We've had this huge push towards jamming as many people as we can into office space. We've had bench seating. We've had, law firms drastically reducing the size of partner offices, associate offices. They don't need law libraries anymore. Jerry Himmlestein can speak to this. There's been a huge reduction in the amount of square feet per person. However, it's widely believed that due to the new things that we've learned with the spread of infectious diseases, is that we're going to now have more square feet per person. So while you might have 20% less people coming into the office, you're probably going to be spreading those people out more. You're going to be having more private offices. You're going to have more breakout rooms and collaboration rooms instead of putting 20 people along one desk, along one row of, a table or something. So that's the big factor that a lot of people aren't realizing is going to change with the layout. So those people, like those banks who are realizing less people are going to be coming to the office, they're probably also going to be needing more square feet per person. So let's say they had space for 100 people, and now they're only going to be having 80 people in the office at any given time. That same space they have might continue to work for them and fit their needs. In addition, Jones Lang LaSalle and other economists are presuming that we're going to be back into growth mode very quickly. I'd be curious to hear what some of these entrepreneurs and business owners on the call today are hearing. Are people? I mean, yes, companies have hunkered down to weather the storm and wait until the sky is clear and we get a clear road to a vaccine. But what I'll be talking about later is with the business owners that I've been speaking to, is that they're all still wanting to grow. They all still want to grow their companies and have an eye towards, as soon as we can get past this pandemic, we're going to be back hitting the pedal full throttle back into growth mode. Has anybody heard any of their businesses or clients saying, yeah, I think once we get past this pandemic, we're going to wind things down and really continue to downsize? Has anybody heard that?
I've only heard that people plan on having less office space, less admin space. That's the direction that I've heard people going in. While you want to have a good culture and things like that, they don't believe that they need to have the office space to do that. But who knows? I mean, we don't know what the real dynamic will be in the next year or two. I would be concerned if I were heavily invested in office space in the downtown area.
Yeah, Bill, I'm not sure I really am convinced yet that even a very
Lost you, Jerry.
I'm not sure that I'm convinced that even a very aggressive economic growth model for businesses, which I agree with when the pandemic lifts, is necessarily going to fill the space again. I'm a skeptic on that, and the reason is I totally agree with the culture issue. However, I do think it will result. I'm not sure that we're really going to go to larger square foot. I know our firm won't. I don't know any professional service firm that I'm aware of in the law firm space that's really thinking about that. I've seen large firms totally rework their secretarial assignments and move into different situations where they're massively reducing footprint in terms of the our headcount. And I don't see people saying, well, I'm going to go back to the space, but I need to be farther away from people. I think that the model in the law firms that I see is the universal space, continue the universal size offices, shrinking offices. But one of the ways you might stay safe is in your own office behind a door.
Right.
And so I'm not, and I think that many of our people are going to, if not permanently, work at home, like many days a week, and we are going to move into probably hoteling sort of situations for office space. So
Sure.
well, I agree. And then the other thing about the economic growth is I'm of the belief that we've had in the professional services area a very good year. I don't know any law firm that's of any mid to decent size that hasn't had a good year, 2020. And the mid-sized firms have been, cushioned by the PPP money, which they've used to pay for their rent and stuff like that, as well as their people. And so but every professional service organization I'm familiar with is very nervous about 2021. Some of those support things are going to be gone. And it's not sure how quickly the economy is going to come back fully. I'm not sure what kind of support that we're going to get from the government going forward. So I'm not really bullish about increase in space. In fact, I'm thinking everybody I know is shrinking space and not shrinking a little bit, shrinking dramatically, even from where they were.
Well, I think that's a fair comment. I want to put a little bit of context around the space that you guys are currently in. When was that originally built out?
15 years ago. Well,
there you go.
I'm sorry, 12 and a half years ago.
12 and a half years ago, there was a big difference in the way law firms were built out. And so I agree with you that law firms today are going to either more of a one size office or just two offices, two different size offices, but both are a lot smaller than what they were 15 years ago. So to put your comment into perspective, your square feet per person, do you have any idea what your square foot per person was before if you're going to be getting new space, but what it is today?
It's around a little under 6, I think.
So that's tremendous. That's huge, right? There's no reason for you guys to stay the same. All signs are pointing to, when the average square feet per person across all industries is 190, and you're at 600 square feet per person, you're well beyond the amount of space that you needed to have to function appropriately. Especially, I think you guys probably, if this space was built out 15 years ago, you probably have a lot of space for libraries and books, which we don't need anymore. So hopefully you guys will be able to get your space down to around 400 square feet per person, as well as, having a more flexible work from home schedule and that hoteling concept. Maybe you're going to need a lot less offices, and that's terrific. You should be. But I think it does need to be put into context when you say we're not going to be getting larger. You are already probably one of the largest square feet per person tenants in the whole city. So that's what I'm talking about, putting things into perspective. Now, I don't disagree with you, that there will be companies that are downsizing. And of course, it's a matter of when we see widespread distribution of the vaccine. To me, that's what's going to be driving the reignition of our economy. Once we have that vaccine getting out, I think people are going to be thinking about ways to grow again. And it may not directly transfer into bringing more people into the office space. But I do think there are going to be the typical company who was 190 square feet per person is going to try and get some more space in between those bench seating people, like the technology companies and other technology-driven businesses that have really focused on collaboration. Another thing I want to touch on with remote-based working, we did mention culture building, but there's two other key factors that if you talk to executives, number one is collaboration. And as we're seeing with a call like this, one person can be talking at a time. It's very difficult to collaborate in a remote session. So, lawyers, a lot of times they go into their office, you work on, you write up your brief or whatever it is, and there isn't a ton of collaboration going on. But think about, when you're in an office and you've got a question for somebody, you walk down the hall, you go into their office, you ask them a question, issues resolved in 20 minutes. When everyone's remote, you got to set up a call. Neither of them are available maybe for 2 days. And then in 2 days, you have your call and you resolve the issue. So you talk about productivity. I think there's a lot of people that would argue that people are going to be far more productive in the office when they can be in person, collaborating, answering questions. And then the third thing is knowledge transfer. How do those junior attorneys learn from their senior attorneys when they're not attached to their hip? There's a tremendous amount of value to being next to the person when they're on the phone and hearing what they're saying, or being at the meeting with them and hearing what they're saying and watching what they're doing. And you don't get that in a remote setting. It's very difficult.
I'm with you on that, Bill. And actually, everything you've described has happened to me in my business, either me personally or people in my group. I am not a fan of working from home. I don't care what anybody says. I do not like sitting all by myself in a room in my own home. I actually find it really restricting. There are other people in our group who dislike it as well. Sure, there are others who like it and they have a great setup. But I can tell you now, not every single person is happy about working from home. It was fun at first, but it's not now. And to your point, Bill, exactly that problem happened. I had an idea. I put together a whole proposal. It was out there. If somebody had been in the office with me, I would have said, hey, quick, let's catch up on that real quick. But we didn't get time. I got distracted. 2.5 weeks later, I'm now back on it. We just were delayed for 2.5 weeks. That's money out the door. And that's going to get worse and worse and worse. So I agree with you, Bill. I think we are already seeing the impact of this, which I think is negative.
Yeah, and we'll get into a little bit later. I've got the approximately 250 business owners that I've spoken with since the pandemic started, and we'll hear from them as well.
I'd like to make 2 points here.
Please.
One is, we're in the business of raising money for companies. We have seen dozens and dozens and dozens of startups. These companies, some of them have grown tremendously in a short period of time. The startups are going to need space. A lot of these entrepreneurs are working from home. They're not going to continue to work from home. Second factor on culture. I cannot tell you how many times now my office happens to be in my home, but I did have an outside office, which I gave up. But in addition to that, I can't tell you how many times I'm having a meeting and somebody said, let's get together. And right now, I'm not going to get together, and neither are they. However, as soon as this is over, I guarantee you the lunches are going to pick up, which we'd love to do. The meetings are going to pick up outside the office, and eventually that's going to lead to more space.
Sure. No, thanks for sharing.
The culture issue is huge. And I agree with Naomi.
What was that?
The culture issue is huge, and I agree with Naomi. I don't like to work from home either. And in passing on the knowledge to younger lawyers, the building of the culture, it's okay now for the first 9 months. You're dealing with mostly people who are already there and you're already in your culture, but integrating new people into your culture will become very difficult. And so I am concerned about that. And just to correct one thing, Bill, I misspoke. It's just under 400, not under 600 square feet.
Okay,
that's a huge number. But yeah, it's a. In fact, right before the pandemic, the year before the pandemic, 2 lawyers left our firm precisely because we wouldn't allow them to work from home 4 days a week. That's how much I believe in that culture thing. And of course, everybody looks at us now and saying, everyone's working at home. Why did we push those people out?
Sure.
This is Barrett. While we're on the topic of cultures, I come from the professional services world, and I can sympathize and empathize with everybody who's on the professional services side. What's been unique for me is one of my clients built out a 40,000 square foot co-working space focused on philanthropic groups. So family offices, foundations, people giving millions of dollars out every single year. And just to put in perspective, these groups are anywhere between one person up to about 30 people. So at the end of the day, they're nonprofits, but they're small businesses. But if you look at the demographics of each, and this is about 15, 16 different groups, they've got everywhere from, just out of college graduates to kind of middle management in their 30s with young kids to, people who are more senior and more executive who are kind of in every different walk of life. And what's been really interesting talking with them about is their junior or the 20s to 30-year-olds are having cabin fever, don't know what to do, feel like there's a lack of connection with anybody there. And the more senior folks are not as willing to go in the office, and probably rightly so. And then the people with young kids, nobody wants them to go in because the kids seem to be transmitting most of the coronavirus and things like that. So it's actually been a really interesting study talking to about 12 of these groups about how they're thinking through this. And I think not only do you have the conversation of what's the right space, what's the right format of meeting with people, I think people in different walks of life just all have different approaches to how they're dealing with this pandemic. And I think that's probably going to last until this time next year as a vaccine rolls out and people get more used to coming down to the city and getting into the office space. Because I've been down, I live in the Loop. I have an office in the Loop. I'm probably in the Loop once a week, and it's a ghost land. It looks like that week between Christmas and New Year's where nobody's in the office and there's a snowstorm at the same time. So really interesting data points, and just thought I'd add that to the conversation.
Yeah, thanks for sharing, Barrett. That is helpful. So this is great conversation. This is exactly the types of conversations that I'm having daily with business owners, and I'll get into that in a moment. I did want to touch on the other two sectors, retail and industrial, where we're really seeing the starkest contrasts and the biggest changes. Retail was already a struggling sector heading into the pandemic. Retail is about bringing people together, right? And that's what we have now been told to avoid. So as such, retail is struggling mightily, and that will continue. There are store closures and restaurant closures. But also keep in mind, there are some good things happening to retail. And those two things are, number one, medical. There's a lot of medical that's transferring into retail spaces. They are private practice physicians, dentists, doctors. They are fueling a lot of the demand in retail. And prior to the pandemic, one of the things fueling retail demand was experiential activities like axe throwing and gaming places. Obviously you can't really do those right now, but that's going to continue. Those two sectors, the experiential and medical, will continue to support retail going forward. But right now we are seeing increasing vacancy rates, more closures, rental rates dropping. And what's interesting is what we're seeing is a lot of the retail use is now being transferred to an industrial use. So the consumer, instead of going to a store to buy their product, is now going online to buy that product. And that product, instead of being in a storefront, is now being kept in a warehouse. And so the industrial sector has been incredibly hot, and mostly fueled by Amazon, which just over the last 12 months has occupied over 15 million square feet in the Chicagoland area. That is some unprecedented demand in our history from one tenant, and that's going to continue. You know, Amazon's looking for a lot of that last mile storage, the last mile delivery. They need warehouses as close to the population as possible, in addition to cold storage. Because now people, instead of going to the grocery store, they're ordering their groceries online. So we need cold storage. And so there's a ton of development going on. There's been a lot of activity in investment sales. So we going into buying versus selling, and that always depends on the type of property, the location, and the price, right? Industrial sector has been booming. The interesting thing there, most of the sellers in the industrial sector, rightfully so, are Chicago-based companies and developers. And most of the buyers are coming from outside of Chicago, as well as foreign investors. There's a huge appetite for industrial properties. There's a ton of development going on in industrial. In the retail side of things, there's just a lot of caution. I mean, as pre-pandemic, oh, looks like we got a visitor. You know, in the pre-pandemic, investors loved triple net leases with AAA credit tenants. What investor doesn't like that, right? Right, Mr. Markman?
Yes, sir. Got it.
And so that's continuing, but it's those smaller strip centers where you've got your tanning salon, you know, and your doggy daycare, you know, maybe a small restaurant or two. Those are struggling, and investors and lenders are approaching retail with caution at the moment. But office space, the investment sales side of office has been somewhat muted, but there are still major properties are trading hands. And I think if you're a buyer, you should be able to get, you know, Jerry pointed out, I think that with rental rates contracting and coming back a bit on the office sector, and potentially companies downsizing and not needing as much space, we're going to see prices coming down a bit in the office sector. But pricing in industrial, they're going up per square foot, both on the leasing and purchasing side. And that's a really hot sector right now, and we see that continuing into the foreseeable future. So these business owners that I'm talking to, what are they saying? What are they thinking? And what are they doing? Out of approximately 250 business owners that I've spoken to, there have been 2 that have said they're not coming back to the office. And to put that into perspective, to put some context around that, one of them was going out of business prior to the pandemic, and I believe they won't have a business to bring back to the office. The other one already had one foot out the door. They were a software development company. They already officed in very odd locations without good access to public transportation. And they said they don't plan on coming back to the office. On the flip side, since I put this presentation together, I've spoken to 2 other business owners who have said, we've never had office space, but as we grow, once this is over, we're going to get office space. And I think maybe Ray Markman had mentioned that a lot of these tech companies that are getting funded and growing that didn't have office space before, they're going to be looking to have some space and bringing their people together to collaborate, build a culture, and have some knowledge transfer. So I think that's an interesting, you know, maybe people are just being nice to me and they don't want to tell the office, you know, the commercial broker that we're never coming back. But that's not what I'm hearing from people.
Yeah, I agree with you, Bill. Somebody did mention about the sort of shared office space. I've been in shared office space since 2006, and I love it. It is the best. Like if you've got a small team, they can mingle with other people. Everything's taken care of. You can rent rooms if you want to expand. You can retract if you don't want to expand. I mean, you know, I feel like some of that is the future too, right? People are doing that more and more. So listen, I think you're right, Bill. Not everybody is going through the same situation. But we're not getting rid of our office space, for example. We absolutely will need it. Yeah.
And I've got a couple, you know, I'm going to get into this in a minute here, but you know, what a lot of these business owners that I'm talking to, what they're thinking is, at least what they're telling me that is on their mind is, we want to get back to the office as soon as it's safe. And how do we promote a safe environment for our employees to return to? And what does that office need to look like and layout going forward for our employees to remain safe at a comfortable distance, so they're not transmitting their colds and infectious diseases to one another? What these business owners are doing, the actions that they're taking, are they're seeking ways to secure some free rent or rent deferral, how to restructure their leases. And some of them are even talking about how they'd like to terminate their leases that they signed in the last 2-3 years when the market was very landlord favorable, and then coming back to the office under new lease terms that takes into account more of the current environment. And I'll get into that stuff a little bit later as well. But, a big comment that I think that, someone made earlier is that the residential market, there's a lot of people that right now are moving to the suburbs, and those residential markets are pretty hot in the suburbs. But there hasn't been a single business owner that I've spoken to that's officing downtown that has said, we need to leave our presence downtown and move to the suburbs. Now, there's always been folks that have questioned the business environment in Illinois in general and thinking about, well, should we move to, Indiana, Michigan, or Wisconsin? But I'm not hearing any business owner say, we got to get out of the city and move to the suburbs. There are some that are saying, maybe we want a satellite office in the suburbs for our employees that are out there. But I've not heard, the reasons why cities have been a viable entity for centuries. We've had cities for centuries now. And those reasons of why humans congregate to an area of mass population, which have been, they want to be around other people. We're social animals. We want to be around entertainment. We want to be around dining options. That's still going to be where people want to live. That's not going to change. And likewise, companies want to locate near their employees. Companies want to locate near their clients and their vendors. And companies want to locate near dining and entertainment options as well. So I don't see a mass exodus of businesses from the city. Yesterday in the same presentation, someone asked me, well, what about for their physical safety? We had the race riots earlier in the year. And Barrett and others that are coming downtown can attest that, right now there are certainly far fewer people moving in and about downtown. But I have not heard a business owner say to me, we're scared for the physical safety of our employees. Business owners have said, I don't want to bring my people back to the office until it's health-wise, it can be safely done. So people are concerned with the health issue, which, as we're seeing right now, we've got some effective vaccines that are starting to get rolled out. It's not going to happen overnight. We're not going to have 90% of our population vaccinated in the next 3 to 6 months. But as Barrett mentioned, most people will agree that, within approximately 9 to 12 months time, we should be in that situation where the vast majority of our population can at least rely on herd immunity, to where we've got this immunity, we've got the vaccine widely distributed, and it will be a lot more health-wise safer of an environment. I'd be curious to hear from anybody if they're hearing from their employees or other business owners that people are not coming downtown because they fear for their physical safety.
I think it was just the peaks of the 2 or 3 periods when there were incidents,
Mm-hmm.
where we as management were getting reports or night, in the morning, we had to make decisions on whether to cancel the office location for the day, for a couple days. When we went through that, and I don't think there's any long-term impact of that. I certainly hope not.
Me too. I was in my office on Monday and I drove down Michigan Avenue just because I think Michigan Avenue is beautiful. And I like seeing it. And just about every other street in the median was a police car with its lights flashing. So if that's not a deterrent to crime, having an officer stay on the ready, that's not what we want to see long term. I don't think that instills a feeling of safety, seeing officers at the ready to take down crime. But I think that the city certainly understands that our downtown is such a key economic component of our state. They need to ensure the safety of the people that are coming to work and play and dine within the city there. So
I think if I can just make a comment that I think there are going to be people who will use that to their advantage. They'll use that excuse if I don't feel safe to just not have to come in, because there are people who do, they have a long commute, they prefer to work at home, it's more convenient. So I've seen it already happen with my team. I know who doesn't care about this stuff, and then suddenly they care, and it's all very dangerous and things like that. So I think people are going to leverage that a little bit to their advantage.
Yeah, Bill, you hit on something in terms of the sort of highlights the timing issue here, which is, let's say, like you said, 9 to 12 months and everything's vaccinated. Probably a period of time even after that, before I think people in my position, for example, are going to have a real feel for what the new normal is like in terms of people working remotely, how many, what our real space needs. I couldn't even project right now what our real space needs are. And I'm very grateful that we have 2.25 years left, because I think it's going to take a full year, maybe longer, before we're really going to have that figured out.
Yeah, Jerry, I think that's a really good point. I've heard that from all the tenants that I mentioned before. They've all called me and said, hey, what's your flexibility a year from now on changing up how many offices we're renting from you, how many desks we're renting from you, things like that. Because they've all said we can't really do anything right now because we don't know what people are going to do in terms of hoteling, in terms of working from home, if they're going to be here 2 days a week, 5 days a week, whatnot. But I think that's a really good point, is a lot of people are not worried about this next 12 months. They're probably worried about the next something between 12 and 24 months and how do they resize accordingly.
you guys are spot on. And that's exactly what this next slide addresses. We have got about 40 active clients right now. And to put that into perspective, a typical broker does maybe 5 to 7 transactions per year. We're going to do about 60 transactions this year. And here's how they stack up. All right. This is what my snapshot of the local small business community is doing. I've got about 1/3 of my clients, maybe a little less than 1/3, that are looking to sublease and shed space. And a lot of them are doing that not because their businesses are struggling, but because they know they're not occupying space now or for the foreseeable future until we're able to get a snapshot of what we think that future is going to look like. And so they're trying to cut some of their expenses by subleasing their space. That's probably maybe 1/4 of my clients. I've got about 1/3 of my clients that bear it, like what you were just saying, and you, Jerry, that are saying, all right, we have leases coming due. We're going to renew for 1 year or 2 years. We're going to buy ourselves some time to understand what the future might look like, both in terms of what the space we're going to need and how it's going to lay out. So there's a lot of those folks that do have leases rolling over. They're renewing. There are a few of my clients that have leases that have come due in the pandemic, and they've said, if we can't, we're not going to occupy the space, so why should we have a lease? So I have several clients that are leaseless right now, and I have agreed with that. I've advised that, and I've said, look, there's no need for you to take space when you can't safely occupy it. So just sit tight, let the market soften a bit, so rates can come down, and that'll be a wonderful time to get back in the market. But to Ray Markman's point, I've got a third of my clients that are growing and they need more space, and they're anticipating bringing more people to the office, and whether it's remaining where they are currently and expanding within their building or relocating to a new spot, so I've really got a pretty balanced spectrum of what my clients are looking to do, but I'm trying to think if there's been any that are where their business is, there's a couple of my clients where their business has really been struggling and they're subleasing space because their business isn't doing well and they don't need it. But that's been the same as in the pre-pandemic. I always have a client or two that says, you know what, things didn't work out. We zigged, but we should have zagged. And until we can regroup, we've got to cut expenses. We got to cut people. We got to cut our office space. And just like pre-pandemic, there's always going to be companies that are growing. And then there's always companies that are just kind of status quo. I'll usually point to a lot of service providers like accounting firms or law firms that, hey, they've got a good thing going. They've got a good team. They're trying to recruit maybe, but they're just not getting traction in that department. And so it's, let's renew. But a lot of my clients that have leases coming due, they're doing short-term renewals. And that's what I mentioned before the call got started here is I feel like I'm working twice as hard for half as much, because the renewal negotiation for a 1 or 2 year lease term still takes a similar amount of effort and time as a 5 or 7 year renewal. But I'm just getting paid less because it's only 1 or 2 years versus 5, 7, or 10 years. Those same clients, once we have a clearer picture of what the future is going to look like, both in terms of health and layout of space, that's when, I think people feel more comfortable planning for the long term and signing those longer term leases. The next section just talks about returning to the workplace safety. I'm going to skip over it because we'll send this information out if you're interested. But I've got a partner in the partner firm that's in the architectural space. They put together a terrific all-encompassing report about steps and measures you can take to safely bring your people back into the workplace. And so I'll share that. We don't need to go through it. But this is really kind of the meat and potatoes. This is what I think a lot of you may have joined for is what can you do as a business to take advantage of current market conditions? Number one, obtaining free rent. I think the price of admission for a landlord right now is to grant their tenants rent deferment. If you ask for that, you should get it. But for me, I want to do better than that for my clients. I want to be able to bring them rent abatement. I want to get them some rent relief that can help them through these times. And again, I can tell you, if you don't ask, you don't get. Your landlord's not going to come to you and say, would you guys be interested in, 4 months of half rent? No. A lot of these landlords have gotten relief from their lenders. They've gotten a period where they can pay half mortgage or take a month or two off. They've achieved that from their lenders in the expectation that they pass it along to their tenants, that they allow their tenants to get a little bit of relief. But when you go to your landlord asking for rent relief, and I'm not talking about deferment, I'm talking about abatement, be prepared to show them that your numbers are down year over year. Maybe you're only showing them the second quarter, because that was the toughest part for most all businesses when we just got the stay-at-home orders and we were all scrambling to figure out what we were going to do. Most businesses were not making long-term decisions. They weren't purchasing items from their vendors. We were all in kind of panic mode, and we just kind of stopped. That's a great time to show the landlord the numbers from that second quarter compared to your 2019 numbers. We've been able to achieve with varying degrees of success rent relief. Most of the larger landlords are willing to do that. They're willing to give you a couple months of half free or a month or two of free rent. Potentially, they'll ask you to add that term on the back end of your lease, which to me is not giving up a whole lot in order to get that. We've done several lease restructures for our clients where we go to the landlord and we say to them, look, we've got 3 years or less left on the term. We're willing to commit to the long term in exchange for a lower rental rate. You know, we call that strategy a blend and extend. You blend your current rental rate down by extending your lease out. It's hard for companies to plan, obviously, but if you're able to maybe tuck in a right to terminate within that lease restructuring, it can help you gain the flexibility you need while still committing to a longer term lease. But really, you got to have under 3 years, preferably under 2 years left for a landlord to want to engage with you in a discussion about restructuring your lease and dropping your current rental rate. So terminating a lease. The most important factor here that I want to throw out there is that I am not an attorney. So do not take legal advice from me. We go to Jerry for our legal advice. All right. But this is based on my experience, both in the past and the present, of guiding a client through walking away from a lease. What landlords will tell you, they don't want to tell you, but what they'll tell you is that, and Jerry, I'd be curious to hear your thoughts and experience on this. Pursuing a tenant who's in default is typically not a financially sound practice, especially if that tenant is actually suffering with financial, suffering financially. It's not going to be a good use of resources for that landlord to go after the tenants. In fact, there's a landlord, Imperial Realty. Guy's name is Al Claremont. He owns approximately 150 buildings throughout the Chicagoland area. He's told me on multiple occasions that he doesn't pursue tenants that default on his leases because it rarely makes financial sense for him to do so. Especially right now, and in Illinois, which is typically a blue state with blue judges, we have a moratorium. A landlord cannot file for an eviction right now. They can't file for, well, actually, maybe Jerry, can they file if you walk away from a lease? Can they? What is a landlord's recourse right as of this moment?
Well, a caveat: I'm not a real estate lawyer. This is a transactional lawyer generally. We have those people. My understanding is that there's a distinction between residential and commercial right now in terms of what is permissible. And I wouldn't even begin to go through the differences of the rules because, again, it's not my area. I will note that there are some high profile cases between landlords and tenants in the Chicago area that are current. You might have read about the Jenner and Block case in our building, downtown law firm.
You're cutting in and out.
I'm sorry, that you might have seen the Jenner and Block case is currently in the Circuit Court of Cook County. It's got a lot of press where the landlord is represented by a downtown firm and Jenner and Block is pretty much representing themselves. And it looks like a pretty titanic struggle. But there are a couple other cases like that. And of course, nothing's really panned out on whether any of those, pandemic related clauses potentially, or, is there going to be a universal rule on that? But it's a tough sledding. There's no doubt about it. People that have talked to their landlords, if you don't have something very specific in your lease, you're not going to get anywhere. I'll tell you that. So
agreed.
But
But
the landlords, I mean, one of the things I'm interested in getting your view on, Bill, is that it seems like, and this is getting to the options that you're talking about, it seems like until there's a market gun at their head, the owners of these buildings will do anything to avoid a reduction in the square foot that is written on that lease, because that's how their buildings are valued. They'd rather give you all sorts of give backs in other areas than that square foot number. And I just don't know how much you
Spot
can
on.
get in trading.
You're spot on, Jerry. So a couple of tips with regards to terminating a lease or walking away from a lease. Number one, always as good practice, record what's happening. If the landlord's ever not able to produce a safe and comfortable work environment, let's say the elevators are down, take note of that. The HVAC system is down, take note of that. If there's ever been a theft in the property or a crime committed, take note of that. Building this case for you as a tenant, in my experience, the 20 years in real estate, I've had 4 tenants prior to the pandemic, 4 tenants prior to this pandemic who have walked away from leases based on various reasons, like HVAC was down, they didn't feel safe in the building. Whatever the reasons were, not a single one of them were pursued by their landlords. Now, this is not, I'm not recommending that, you just walk away from your lease, but certainly keeping track of what's happening. And when the landlord hasn't been able to perform its duties and potentially declaring that the landlord is in default because they haven't provided quiet enjoyment or the opportunity for you to, successfully run your business out of the space they're providing. It's very important to keep note of that. So that's one issue. But of course, if you've got financial factors where your business is really struggling, a lot of times landlords see pursuing that as a losing financial proposition. So I'm always happy to have conversations about that. I would 100% always include a qualified real estate attorney in that discussion. But essentially, that's what my presentation is today. I'm happy to address any specific questions or, continue the conversation. But this is what I'm seeing in the market right now. This is what the business owners I'm talking to are saying to me. And I know we all talk to different people and hear different things, but this is kind of just, the statistics I've gotten are mostly from CoStar, who's a commercial real estate database company.
Can you call me tomorrow? I cannot take the call now.
And so if anyone has any questions, I'm happy to address those.
Well, I guess just to follow up my last question, Bill, which was, if we're not going to get in the short term any sort of lower rents going forward until the market changes even more dramatically, then how much wiggle room is there in this market to get these different kind of tenant breaks, whether it's blended rates, whether it's build out expenses or anything.
It's a great question, Jerry. So number one, when you do get free rent, you're lowering your net effective rate, right? So when you factor that into what you're overall paying, your net effective rate is going down when you've got more free rent. I do believe that there are some landlords out there that are getting aggressive, that are realizing that there might be some headwinds heading to the office market, and they're going to try and be a little bit more aggressive. So I don't think you're going to see direct landlords dropping their rates 30%, maybe not even 20%. But if you can get a 15% reduction in your direct rental rate, as well as additional free rent and potentially some more flexible clauses in your lease, I think you're going to be doing okay. The next 2 quarters or so, first and second quarter of next year, potentially into the third quarter, we will start seeing negative rent growth. We will start seeing landlords being fearful of the future and wanting to solidify their tenant roster. Because as you said, the value of a property is determined by the rent roll. That's how you value these downtown office buildings is, how not only how much your tenants are paying in rent, but how long the firm term goes out for. So before, right up to a right to terminate, that's how a lender and a potential buyer will value the rent, and then apply a multiplier on that number to get the value of the property. So I think there will be opportunities, but as I mentioned, once I am in firm belief, and this isn't, I don't think it's wishful thinking. I think it's listening to economists and constantly being on calls with real estate folks and reading everything I can get my hands on from both economists and real estate professionals. Once this wide distribution of the vaccine occurs, I believe we are going to see economic growth. And when we see economic growth, we're going to see businesses expanding. And even if they're having a smaller footprint in terms of number of people, there's wide belief that that amount of square feet per person is going to grow. And as the Jones Lang LaSalle study concluded, there will be a net no gain or loss in the amount of demand needed over the next 2 years. So there's going to be a moment of the next quarter or two, potentially 3, where there'll be some negative rent growth. To me, that's going to be the time to strike your lease transactions. We're at a 13.5% vacancy right now. I think it could potentially climb a little bit more. I mean, I don't think we're going to pass the last 2 recession levels. I don't think we're going to go past 17 or 18%. But, even if we get to 14 or 15%, it's going to signal a great time to be a tenant. Those tenants who do still need space, we're going to see great opportunities to get huge tenant improvement allowances and huge free rent concessions, in addition to a modest drop in your rental rate. I don't know, did that answer at all what you were?
Yes, thank you.
Okay.
Are there any other questions? Bill, you did a great job. I'm going to give you an applause.
Thank you.
And also, not only applause, we'll give you a thumbs up too.
Ooh, I'll take it.
Okay, you'll take it. So if anybody, what we'll do is we recorded this. We'll be happy to send you a copy of the recording if you like. And thank you all for attending. And
Yeah, I appreciate everyone being here. It was good to see all your faces, and I'm always available to chat about this further or answer any questions. And, I live and breathe this stuff every day, all day. And I really think at the end of the day, we're going to see great opportunities for tenants, that's who we represent. We represent the end user of real estate. I think if you're looking to be an investor in the industrial sector, your prices are going up. So Jim, I think that opportunity to purchase your building while it'll still be there, I think your prices are going to be going up on you. But I'm always happy to chat, talk shop. I love talking real estate. So thank you all for giving me the opportunity to do so.
Thanks, Bill.
Great job.
Thank you.
Great job.
All right. Take care, everybody. Stay healthy. Happy holidays. And thank you, Ray.
Thank
Both
you.
Rays. Thank you, Mr. Markman, for being here, and thank you, Mr. Silverstein, for putting this on.
Bill,
Yep.
could you send me the names, email addresses and phone numbers of the people who were there? There are some synergies that I'd like to take up on.
You're somebody that I have no hesitations to putting in front of anybody in my network. So I'd be honored to do that.
Yep, I would appreciate that. I'd like to follow up.
You got it.
Ray, you and I met a long time ago. I'm trying to place the place where it was.
I think we lost him.
Ray got off. Okay.
Thanks for joining, gentlemen. Enjoy the rest of your day.
Bill, it was great. Thank you.
Thank
It
you.
was really great. I learned
Appreciate
a lot.
that.
I learned
Good
a
deal.
lot. It was a great course.
All right. You earned your credit, your real estate credit.
No, you're no, Bill. You're really terrific. I would nominate you anytime.
Thanks, Ray. Enjoy the rest of your day, my friend.
You too. Thank you.
Be well.
Thanks.